Hello everybody, welcome to another episode of Erickson TV, courtesy of Lauren. Hey Lauren.
Hey everybody.
Lauren, I wanted to continue on with our series that we started last week, just about the good times are ending with the tax code. And the one thing, just to remind people that haven't watched the episode, we talked about dividends, and there's been a lot of talk about dividend paying stocks and how good they are for returns. And there's a potential tax issue starting January 1st of 2013 where the current tax code is expiring and we're going to go back to the 2001 tax code unless the current president at the time and the current Congress can come up with a resolution or a new tax package, which, based on what's been happening in Washington, pretty unlikely.
I wouldn't expect anything better or worse or anything to happen at all.
So we talked about dividends, so let's talk about capital gains. And capital gains, some people will say, well, I haven't experienced capital gains in a lot of years, but you could have capital gains selling real estate that you held for years. You could have capital gains from selling stocks or mutual funds that you held for years. And basically it means you made a profit, but it's an investment type profit. And so under the current law, which is good through the end of 2012, depending on your income, if it's a long-term capital gain that you've held longer than a year or a year later, it could be anywhere from a 0% rate to no higher than a 15% tax rate.
Right, exactly.
And so what's going to happen when it expires?
Well, the tax rates are going to go up.
Right.
You're going to go up to 10 and 20%.
Right, and so that 0% totally goes away.
Right.
And then and then for short-term capital gains, and actually for people that have held a security or an investment less than a year, that's considered a short-term capital gain.
Right.
That is based on your ordinary income tax rates. Whatever your highest tax bracket rate is what the tax rate is.
Yeah, and short-term capital gains are something that we try to encourage everyone to basically avoid. Right, because they're taxed at ordinary income. Long-term capital gains, like Curtis said, a lot of people don't have very many, right now. But long-term capital gains are not the big problem that a lot of people think they are usually anyway.
Right.
And the first misconception, a lot of people think if you sell like $100,000 of your mutual fund, you get taxed on $100,000. Well, that isn't true.
Right.
You only get taxed on your gains. But one thing that I learned when I sold something a few years ago, there's two kinds of basis. There's the basis just what you bought it at.
Right.
But then there's average cost basis, which in some cases can be a lot different. Because as your fund goes up, and I'm mostly talking about funds here, if it reinvests dividends, every time it gets reinvested, you get a new cost basis.
Right.
A new,
because they're paying tax, and you're paying tax on the dividend. It's being reinvested by
yeah. So what happens is, as those dividends get reinvested, if you invest in a fund that goes up and down and up and down, even if it has a gain, oftentimes your average cost basis is not so bad.
Right.
So even though the capital gains tax rates are changing and they are going up, they're not going up by as much as the dividend rates. And also, capital gains is not, well, it's not like income tax.
Right.
It's not as scary of a tax. It's not something to be worried about as much.
But I am worried about the short-term people, traders, and the people. Like a lot of times, when people that cash in their stock options at work,
exactly,
and they trade, they sell that immediately. That's a short-term gain.
Right.
So under the new law starting January 13th, there's also this healthcare supplement tax. So for the highest earners, the current highest short-term capital gain tax is 35%. It could be as high as 43.6% for a short-term gain. So so I think the moral of the story, if at all possible, invest in the long term and create long-term gains. But if not, then maybe you can do some tactical planning to match some other capital losses with other capital gains.
Right, exactly.
So thank you for watching this episode, and feel free to contact us if you're worried about a capital gain issue, and we'll see you next time on Erickson TV.
See you next time.